Hello and welcome to BQ Prime. You're joining us in this special conversation with Mr. Keki Mistry of HDFC Limited. We are discussing the second quarter results of the housing finance company. Mr. Mistry, thank you so much for joining us, and I hope you're having a great post-Diwali week.
Thank you. Thank you very much.
Sir, looking at the results now, so you've reported about an 18% rise in the net profit portion. That has mostly beaten most of the estimates that analysts had made. On the NII side, again, there's a 13% rise. However, other income was slightly lower than what it was last year. I'm just curious to understand where these numbers stack up and how exactly you're reaching these figures, sir.
All right. So net interest income, first, we must understand that with all the loans that we give to the customers, at least for individual customers, the agreement that we have with the customer provides for a change in interest rates every 3 months.
Right.
And it's 3 months from the month in which you took a loan. So if someone took a loan in the month of January, his interest rates can change in January, April, July, October. If he had taken a loan in the month of February, it would change in February, May, and so on and so forth, every 3 months. Now, when RBI increases interest rates, and in the first quarter of last year, we saw a very sharp, first quarter of this year, we saw a very sharp increase in interest rates. And we immediately pass on the higher cost to the customers. It happens whether it's higher cost or lower cost, decrease in interest rates is passed on to customers.
Right.
But the impact it has on our earnings will come in only over a period of 3 months, which means roughly on an average, it takes 1.5 months for the full impact of the interest rate increase or decrease to percolate through to the customers. Whereas on the borrowing side, the increase or decrease in interest rates is immediate.
Right.
So there is always a time lag, or what you call a transmission lag, which is typically about 1.5 months.
Right.
In the first quarter, whatever increase in interest rates happened were passed on to customers. And today, the interest rate that customers are paying, all customers are paying, is after factoring in those increases.
Sure.
But if interest rates were increased, let's say in the month of September, theoretically, they were not, but let's say they had been increased in the month of September, then when we were preparing the September accounts, the cost would have been impacted immediately, whereas the benefit of the higher rate would have not fully come through. So there is always a transmission gap. So that's on the net interest income side. If we adjust for that transmission gap, the growth in the net interest income would have been 16%, in line with the growth on an AUM basis for the book as a whole. Individuals grew 20%, non-individuals grew only 1%. Overall growth in AUM was 16%. That's as NII is concerned. As far as other income is concerned, it depends. There are certain accounting rules in India which apply to non-banking finance companies and housing finance companies, but not to banks. So, for example, for our investments, we have a one-time option which we have to exercise at the time when we migrated to India's accounting to account for some changes in market price of the share, either through P&L account or through balance sheet. Now, for all our subsidiaries and associate companies, we take it through the balance sheet. So the unrealized gain, which is not accounted for in the P&L account at all, on our listed investments is 2,24,781 crores.
Right.
But there are 2 or 3 investments which were treasury investments which we had made, where we take the mark to market through the profit and loss account.
Okay.
So in periods when the markets are weak, that tends to come down. You can even theoretically have a loss in that. And in another quarter where the markets are good, that would show a big rise. So that creates some amount of volatility in the non-operating income.
Okay. I'm just also trying to understand this 15.5 or roughly 16% AUM growth that you've reported. Your AUM is about 6.95 lakh crore now. This is adding all the loans that you've sold. The pace at which you're growing, how sustainable is it in this rising interest rate environment? Because I know you've always maintained that interest rates don't really affect home buyers. At the end of the day, it's a decision to buy a home or not. But then at some point in time, it has to eat in, right? I mean, that's the logic we're working with. So at what point do you think that will come into effect?
All right. So first of all, interest rate increases. Let me explain why interest rates has a lesser impact on housing loans than other products. Some sentimental impact is bound to be there. Let's understand there will be some sentimental impact. But on an economic standpoint, the impact to a customer is frankly not there. Because a housing loan is a 15-year loan.
Yes.
In a period of 15 years, interest rates will go up and interest rates will go down. Nobody today gives fixed rate loans. Everyone gives floating rate loans. So when you've taken a floating rate loan, it does not really make too much difference from an economic standpoint, whether you've taken a loan at a time when rates are high or rates are low. Because if they are high, they will become low at some point. If they are low, they'll become high at some point. So over a period of 15 years, it all sort of evens out. So economically, not much impact. Emotionally, sentimentally, of course, there will be some impact. But historically, housing loan interest rates in India have been higher than what they are today. So logically, to my mind, another 15, 20, 30, 50, 75 basis points in increase in interest rates may not have any material impact on demand for households. And people, when they're looking at taking a loan, are largely looking at the economic factor, how comfortable they are with their jobs, how confident they are of not only retaining their jobs, getting salary increases, all of that. And that sentiment has been very strong. So the economy in India today is probably very, very strong and so counterintuitive compared to what we are seeing in the Western world. Our economy is very strong. Our growth, job opportunities are very strong. People's salaries are increasing at a much rapid pace compared to what historically they was. All that is creating this sense of confidence.
Okay. A recent data check that we did showed that the demand is on an aggregate basis, it is on the luxury and upper end of the market, while on the affordable side it has tapered a little bit. Are you seeing something like that in your portfolio as well?
I would put it this way, that whilst I won't use the word affordable, I would say growth in tier 2, tier 3 towns constituted a larger percentage of our growth in, say, pre-2020 compared to what it does today. The reason is not that the tier 2, tier 3 towns or the lower income or the economically weaker section people, as that growth has slowed down. That is not the case. It is just that the higher end of the market, which was very, very subdued right from 2017 to 2020, that has now started seeing a sharp pickup.
So that's a rebound that's showing up.
So it's a rebound in the higher income bracket. The middle income and the lower income group continue to remain what they were doing. It's not that has not slowed down. It's just that the higher income groups, the growth has been stronger. The metros, the growth has been strong.
Okay, last couple of questions. I just want to get the asset quality that has improved significantly, even on a sequential basis, and this is despite you having adopted the RBI's new recognition norms before a lot of other players. What is the outlook looking like there? And then after that, I'll come to the last question. Sir.
I mean, very honestly, the outlook at this moment continues to remain strong. Our collection efficiency, which is the amount of money we collect cumulatively, is now over 99%. And I must say this is cumulative collection. This is not collection only for the month. If a borrower is outstanding for 2 months, then whether we are collecting, both the installments or not. That's cumulative. So cumulative collection efficiency is 99%, which is as good as it ever gets. A gross non-performing loan calculated as per the old method is 73 basis points, which is again as good as it used to be, pre-COVID. Based on the new norms, it is 91 basis points, which is much lower than the 1.44% we had in December. But I mentioned at that time also that will taper off gradually over a period of time. And now we've seen this at 91. So at the moment, there does not seem to be any concern as far as asset quality is concerned.
Okay. Lastly, because I have you here, and this is a hot topic, the merger and the progress that you've made so far. Do you think that probably HDFC Bank on its side has said that maybe by the second quarter of the next financial year you'd be able to see the merger closing? Do you agree with the timing? Do you think that that's a reasonable time frame?
That's something which we've always said. Our expectation was that the merger should get completed somewhere in the month of May or June of 2023. The progress, that's the expectation today, but I mean, this is an expectation based on our calculation of, various approvals and how and when we will receive them. If we get it faster, it could be faster. If we get it slower, it could be less slow. So, I mean, frankly, 15 days earlier or 15 days later is not going to make a material difference in any manner whatsoever.
Yeah.
What we've got now is the in-principle approval from all the regulators.
Yeah.
Because HDFC is not just a company as a finance, not just a finance company, we are a conglomerate. So we have life insurance, general insurance, asset management, pension, housing finance, bank, all of that. So when we need approval, when we do a merger of this magnitude, we need approval from every one of these regulators.
Yeah.
That in-principle approval we have got. We have got the approval from the Competition Commission. We have now got the NCLT has now fixed 25th of November as the board meeting of the share. The EGM of the shareholders. That will happen on the 25th of November. Thereafter, also there is a procedure which needs to be followed. So, for example, in asset management company, because we have mutual funds, we have to write to all the unit holders of the mutual fund and say that, look, we are, the promoter of the mutual fund is now not HDFC Limited, but HDFC Bank. Do you have any objection?
Right.
Nobody will have an objection, but it's still a process which has to go. So all that process will take some amount of time. But I would say June, to my mind, May, June, probably June would probably be the most likely time as it looks today.
All right. Thank you so much, Mr. Mistry, for joining us on this conversation. And thank you so much for watching.
Thank you.